In today's video, we're going to run through part 2 of the dividend portfolio deep dive that we started last week. And that means looking at the total return as compared to the S&P 500 in the last year, the last 3, 5, and 10 years. Because if it isn't beating the broader market, then why am I holding it in my portfolio? So let's start by talking about total returns. And if you're new to dividend investing, this is a pretty important concept because not only are we looking at share price appreciation, but we're considering all the dividends that we're receiving and reinvesting them. And that's how we come to the total return. Now, in that last video, we talked about how I am putting my strategy into place this year, and that is looking for companies that have a compound annual growth rate of greater than 6%, have at least 5 years of dividend increases, have sustainable payout ratios, meaning they're less than 60%, and if I'm entering into a position or adding more to a position, I want to buy in at a PE that's less than 20. Now, if you watched a few of my videos, you've probably figured out that my brain tends to like structure and order, so I tend to apply that to my way of thinking when I put these videos together for you guys. So when reviewing the companies in my portfolio, we're actually going to do it by the sector that they fall within. Now, we're going to start right here with all the ETFs that I presently hold in my portfolio. And there are 4. We have HDV, JEPI, SCHD, and DGRO. For starters, we're going to look at how they've performed in terms of total return in the last year. And you can see that the top performer in the last year is actually HDV as compared to the S&P 500, followed by SCHD, JEPI, then DGRO, with the S&P 500 actually bringing up the rear. And looking at the last 3 years, you can see something changes here because JEPI has only actually been in existence for the last 2 years. So you can see that the metrics for JEPI are only measured from the time that it was actually started. But looking globally at the last 3 years, you can see that SCHD brings in the greatest total return, followed by JEPI, DGRO, and HDV. Now, as we move into the 5-year comparison, I'm actually pulling JEPI out of the mix because, again, it's only been in existence for a couple of years. But if we look more globally, we can see now here, SCHD still with the best return, followed by DGRO, HDV, and then the S&P 500. And if we take it a little bit further, you can see that DGRO is also not one that's been around quite as long as the others. Looks like 2014, but looking globally in the last 10 years, SCHD still takes the win, then followed by the S&P 500, HDV, and DGRO. These are all ETFs that I'm thinking I'm probably going to keep in my portfolio. The next sector that we're going to take a look at is the healthcare sector. And here I have 4 holdings as well. I have shares of AbbVie, Medtronic, Johnson & Johnson, and Pfizer. So looking at this in the last year, obviously AbbVie has the best performance, followed by Johnson & Johnson, Pfizer, then the S&P 500, with Medtronic bringing up the year with a negative 20.59% return. At the 3-year total return mark, we see AbbVie still in the lead with 114% return, followed by Pfizer at 54%, Johnson & Johnson at 35%, and the S&P 500 at just under 20%, with Medtronic definitely underperforming in comparison. At the 5-year mark, we see kind of more of the same. AbbVie out in the lead, followed by Pfizer, Johnson & Johnson, and finally the S&P 500 and Medtronic. And at the 10-year total return mark, AbbVie again in the lead with 631% total return, followed by Johnson & Johnson, Pfizer, the S&P 500, and finally Medtronic. Now, what would you all do? Would you keep Medtronic and just see how things are going to play out? Or would you remove that position from your portfolio and add a little bit more to these other healthcare giants who clearly are doing very well in comparison to the S&P 500? Leave me a comment. Let me know what you guys think. Next, let's look at my financial sector, which is really kind of a hot mess, you guys. Looking at this is the total return in the last year, and the 4 holdings that I have are Barings Business Development, TD Bank, Main Street Capital, and T. Rowe Price. Now, in the last year, Main Street Capital, TD Bank, and Barings Business Development actually all did outperform the S&P 500, with T. Rowe Price bringing up the rear. Within the last 3 years, TD Bank is the only one to beat the S&P 500. In the last 5 years, Barings Business Development actually jumps out in the lead, followed by Main Street Capital, then the S&P 500, with TD Bank and T. Rowe far beneath for total return. And if we stretch out the timeline even further to the last 10 years, you can see that the S&P 500 is definitely in the lead. And now we've got a negative return for Barings Business Development. Looking at my one and only utilities company is Algonquin, and unfortunately, at the 1-year mark, well underperforming. The same story is true at the 3-year mark, the 5-year mark, and the 10-year mark. That being said, I'm not really sure if it's worth it to keep this in my portfolio. I may want to wait until that share price comes up a little bit so I'm not taking such a huge loss. What are you guys doing if you own shares of Algonquin? Are you just going to wait and see? Let me know. Next up are my two internet technology holdings, which are Broadcom and Intel. And you can see in the last year, my top performer in this bunch is Broadcom, followed by the S&P 500, and then Intel bringing up the rear. In the last 3 years, we see a similar story, with Broadcom out on top, which we continue to see in the last 5 years and in the last 10 years. Look at the Broadcom total return, you guys, 2,120%. Next up, let's look at the holdings I have in the real estate sector. And I've got CareTrust REIT, Realty Income, Stag Industrials, and Arbor Realty. Within the last year, Realty Income is the top performer, followed by CareTrust REIT, the S&P 500, then Stag Industrials, and Arbor Realty. But let's move this out to 3 years and see what we've got. And it's at this point in the last 3 years where you can start to see Arbor Realty is really doing much better than the S&P 500, followed by Stag Industrials. Within the last 5 years, all four are beating the S&P 500. And in the last 10 years, the only one not to beat the S&P 500 is Realty Income, which I was actually kind of surprised about. Let's take a look next at the two companies that I hold within the consumer discretionary sector. And in the last year, the S&P 500 is actually beating both Home Depot and Lowe's. But let's stretch out that timeline a little bit further. And you can see just like that, in the last 3 years, both Home Depot and Lowe's are beating the S&P 500, which we continue to see at the 5-year mark and the 10-year mark. The next sector we're looking at is the consumer staples, and I have 5 different holdings. I have Hershey, Altria Group, Pepsi, Procter & Gamble, and Philip Morris. And in the last year, all 5 of these companies are outperforming the S&P 500, with Hershey showing the greatest total return of all. At the 3-year mark, we see that all of them are beating the S&P 500 with the exception of Altria Group. At the 5-year mark, we see that Altria Group stays well below the total return of the S&P 500, and Philip Morris actually starts to drop off, but we have strong total returns from Hershey, Procter & Gamble, and Pepsi. If we stretch out into history a little bit further and look at the last 10 years, we can see that Hershey is definitely our top performer, followed by Pepsi, Procter & Gamble, then the S&P 500, Altria Group, and Philip Morris. For now, I only have one company that's traded in the materials sector right now, and that's Olin Corporation. And you may remember that Olin has not had any dividend growth at all. They've been providing the dividend for a good length of time, but no growth. But if we look at the total return for Olin, I think you guys are going to actually be pretty surprised. If we look at the last year, Olin is 7.65% in total return. The last 3 years, we have a 265% total return. The last 5 years, we've got a 74% return, and in the last 10 years, they're still beating the S&P with a 245% return. And just to pop on over to the dividend scorecard, just to kind of see how they stack up against other companies in the materials sector, it's pretty strong overall. The biggest disappointment here is the 5-year dividend growth rate and no years of dividend growth. They've got a very low payout ratio of only 8.58%. I keep saying that. I feel like they've got some room to grow this dividend. And a dividend yield, it's only 1.42, but they're beating the S&P, you guys. Anybody else have shares of Olin in their portfolio, or is it just me? I feel like no one talks about this company at all. All right, now let's talk industrials. And I actually, with the exception of 3M, I really kind of like what I've got going on here. Snap-on's the newest addition to my portfolio of the bunch, but if we look at the last year's total return, you can see that Lockheed Martin is really, really out there. 35% total return, followed by Raytheon, Snap-on, then the S&P 500, with 3M bringing up the rear with a negative 25% return in the last year. If we stretch that out to the last 3 years total return, you can see that Snap-on really jumps out in front with 54% total return, followed by Lockheed Martin, then the S&P 500. Within the last 5 years total return review, we've got Lockheed Martin in the lead with 62%, followed by Snap-on at 50%, then the S&P 500 with Raytheon and 3M bringing up the rear. Looking at the last 10 years, you can see the total return for Lockheed Martin at 570%, which is pretty fantastic, followed by Snap-on at 266%, and then the S&P 500 at 164%. I think for now, I'm probably going to kind of hit pause on adding additional shares of 3M. I want to see what happens because I think my money is better placed within Snap-on and Lockheed Martin right now. So let's take a peek at the telecommunication companies that I own, and it's AT&T and it's Verizon. And it's not super impressive overall, except within the last year. AT&T actually did well, but as we move out into the 3-year, 5-year, and the 10-year total return, you can see that the S&P is absolutely squashing both Verizon and AT&T, which has me questioning what I want to do with the telecom sector. Are you guys going to continue to invest in Verizon and AT&T? Leave me a comment below. So that wraps up part 2 of my dividend portfolio deep dive, and it leaves me questioning a few things. What am I going to do with my financial holdings? What am I doing with Algonquin? And what's my plan for telecom? Would love to hear in the comments below what you guys think of all these companies and what strategy you might be putting in place for your portfolio this year. Now take a look at this video next.